Welcome to the Ideal Investor Show. Join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we always want to talk about what really makes you money, what generates cash flow, what do we see in the markets, and what have experts in our great interviews told us and let us learn. But today I want to remind you to check out the link below in the description for the episode so that you can see how you can get the free $10,000 passive income strategy, as well as if you are a paid subscriber, and that's because it only really costs you less than $2 a week, you would get the mindset manual, the mentoring journey PDF, our ebook, and a whole lot more. So for today's episode, the title is Understanding Economic Indicators That Influence Real Estate. And I'm sure if you have paid attention even a little bit to the news, you have seen that the so-called economic indicators that we're typically looking at are all over the place, right? Like one thing that we have seen is that 1 month unemployment goes up, another month it goes down. 1 month we have more good news and people are more optimistic about the economy and where it's going. The next month it's going down. Now, one massive driver has been this whole announcement of tariffs that the current administration has started around the beginning of April 2025. And what that has done, number one, is that people are hesitant to take money in their hands to do something with it, because they don't really know yet what the impact of those tariffs will be. So just, if you just look at China, the current tariffs at the time when I'm recording this episode is 145%. But on the other hand, it started in, I think it was February, it was 10%, then it was 25%, then it was 38%, then it was 83%, then it was 100%, and then in the end it was 145%. And on the flip side, the Chinese didn't just say, okay, well, that's all fine, we don't care, but they actually followed along, slightly delayed. And right now, as I said when I'm recording this episode, so the US is basically charging China 145% on most things that come from China, and China is charging everything that comes from the US into China 125%. Now, what does that really mean? And you don't need to be particularly good at math, but anything above 100% means basically the price doubles. So if you think about something that comes from China, and if you go through the stores that you frequently go through, you will see that so many things we have all gotten used to coming from China. And they basically, at least for those people who import them to make them then available in the stores and supermarkets for us, for them, it's going to double in price. Are they going to send all those doubled prices to us, meaning that we have to pay double? Maybe, maybe not. They could say, okay, we are cutting down on our profits to eat some of that. But when you're doubling the price, there is not that much profit that they can basically keep the prices stable. Now, what does that have to do with real estate? Well, one of the things that happens is when you tell everybody in the world that you're going to charge them tariffs, maybe not as high as for China, but in general, you want to charge every country some sort of tariffs, then everybody knows that your willingness, anybody outside of the US will have to say, okay, are we willing to pay for American debt? What do I mean by that? If you really look around, and you have probably seen it and heard it in the news, the United States is approaching $36 trillion in national debt. It may even be above it by the time you're listening to this episode. So obviously what this means is other countries have bought treasury bills and bonds worth $36 trillion. And if we start threatening them, they are less likely and less happy to buy more of these bonds. Now, what people sometimes forget is that these things are not forever. They have basically terms. Some are for 2 years, then some are for 3 years, for 4 years, 5 years, 10 years, 20 years. So a certain amount of those $36 trillion in debt needs to be renewed. So if you have a 2-year document, a 2-year bond, let's say that has a 3% interest rate to it and is worth $100, and we're looking at it now, if you want to renew it, it is probably 5% interest rate for $100. What does that mean for us as taxpayers? That means that the government will have to pay more on interest than it used to pay for the last one. And when you take all of those together, the ones that are most relevant to real estate are the ones with 10-year duration. So treasury bills with 10-year duration, or the so-called 10-year bond, that interest rate is the one that is directly influencing real estate, because that's the basis for the calculation of our mortgage interest rate. How does that work? Let's say the treasury bond interest rate for a 10-year is 5%. And by the way, when I'm recording it, the current rate is about 4.6. And it's fluctuating. It's been fluctuating between 4.3 and 4.7. So right now it's 4.6, but definitely relatively elevated. So that's basically what a bank has to pay for a 10-year treasury bill. Now, when they give it out for a mortgage company, the mortgage company adds typically 2 to 3%. So let's say it was 5% to buy it. You add another 2%, that means 7% for a regular mortgage if you buy a house for yourself. And then if it's an investment mortgage, they add another percent, so you're at 8%. Right? So again, 5% plus 2% plus 1%. Now, if the treasury bill interest rate goes down to 3%, then our cost for the mortgage also goes down from 5 to 3, meaning like instead of us having to pay 8%, we only have to pay 6%, which also means that our cost is down, but our rent remains the same, so we have more money in our pocket. And that's how the economic indicators, especially how much are people believing in a growing economy, how expensive is it for the government to borrow, and how much are people believing that they're going to have jobs so that they can actually either afford a new house, make an investment, or pay an increased rent. All those things are directly related to real estate. And when it comes for us to buy more real estate, the mortgage interest rates decide if we can afford another investment or not. And by the way, for anybody who is looking to buy a house for themselves, it also influences if they can buy a house or if they have to remain tenants. So those are some of the examples, and you can see the likelihood of countries being happy to buy our debt so that we can basically continue to consume is going down the more we're asking them to pay tariffs. So that's the connection there. I hope that was informative and educational for you, and be well and stay safe, and I hope you decide to become a subscriber. So until next time, bye.